Hi, welcome to our 2-Minute Tuesday for December 16th of 2014. My name is Roger Balser Wealth Management. Our title this week is Back to High School. This week we're going to discuss bell curves. Bell curves are something that most of you probably remember learning way back in high school, but this concept can be applied to the point and figure charts we use here at Balser Wealth Management. Bell curves can supply us with some very useful information when we apply them to the point and figure charts. The concept of a bell curve is really pretty simple. You've got that curvy part in the middle and the two extremes on the left and the right. The whole idea behind a bell curve is to find out where your data is normally sitting. I'm going to show you an example in a minute of what it looks like when we're using the point and figure charts. But the important thing to remember with bell curves is you're going to find that most of your data is going to be between 1 and 2 standard deviations to the right or 1 or 2 standard deviations to the left of the bell curve. Most of the time and most of the stuff that you own is going to be sitting right around that middle of that bell curve. So what you've got to know with these bell curves is that most of the time you're going to find your mutual fund or commodity or stock is going to be hanging around the middle of the curve. That's about 2/3 of the time it's going to be sitting right around where we have the middle. But what happens is every now and then you get some crazy thing that happens out there, as we're starting to see right now in this stock or mutual fund or even the market. It just gets extremely bought or extremely oversold, and that's really important to know when this is happening, and make sure that you're not doing something stupid such as selling at the exact bottom or buying at the exact high. What you're looking at here is an example of a curve on the flat. What I did here was we kind of flipped the bell curve chart just a little bit to give you a better idea. So if we're looking at the chart, when you get to the top of the trading band, you've probably heard me say before that this is the top of the trading band. And when you get to that, you don't want to chase it. What we're seeing right here with this slide is actually the S&P 500. And as you can look at it, the top of the trading band is about the 2100 area, which is the top of the bell curve, which is 2 standard deviations to the right. 2 standard deviations to the left would be the 1870 area, and that would be the left-hand side of the bell curve. Right now, what we're seeing happen in the market is a pullback. We have pulled back to a normal area of the market, right smack dab in the middle of the trading band. I don't think we're going to see a big problem going forward here, but once again, we do not predict. What we do is we follow the charts, and when the charts change, we change. And what we're seeing right now from the chart is a normal pullback to the middle of the trading band, and the market is still in a positive trend because it's trading above its bullish support line. I'd like to wish everybody a Merry Christmas. We're going to be off for the rest of the month on the 2-Minute Tuesdays. Hope you and your family have a very fine holiday season, and we'll get back to you right after the first of the year. As always, if you have any questions, please feel free to give me a call at 440 934 3114.